Wait, before you read another company's profit number and trust it completely, stop for just a moment. Here on the ViewPoint, we show you things most people never find out.
Welcome to our explainer toolkit for evaluating financial statements. We're going to decode all that complex accounting jargon straight into plain English. Today's agenda is simple. We'll cover the profit manipulation spectrum, revenue recognition magic, depreciation magic, related parties, the cash flow reality check, and finally, those critical warning signs.
On the ViewPoint, let's dive into Section 1, the profit manipulation spectrum.
Think about shifting financial numbers kind of like legally claiming next month's salary today just to make your bank balance look amazing right now. Companies actually do this legally to make their current performance look explosive. But, there's a massive difference between a little accounting flexibility and outright fraud. At the extreme end of that spectrum, the historic Satyam scandal. Just look at the fabricated bank balances and fictitious invoices we're highlighting here. Between 2003 and 2008, they reported sales of rupees 5,200 crores, totally ignoring the real numbers. They completely crossed the line from aggressive accounting right into criminal fraud.
On the ViewPoint, let's look at Technique 1, revenue recognition.
So, imagine you buy an annual gym membership for rupees 12,000. If that gym books the entire fee on day one, well, it creates a really dangerous illusion of instant growth. Why? Because they still owe you 12 whole months of service. In India, this is governed by Ind IS 115. Every single company must follow the strict 5-step model you're seeing right here. The absolutely crucial concept to understand in plain English is Step 5. Revenue requires a real transfer of control to the customer, not just a signed contract. You only book that revenue when and as the company actually delivers on its promise.
Let's put this into perspective with some illustrative data from ClearView Technologies. Their honest revenue was rupees 3,840 lakhs, but by recognizing revenue up front on multi-year contracts, they manipulated it to appear as rupees 4,800 lakhs. That is an artificial inflation of rupees 960 lakhs. Because of this little trick, their days sales outstanding jumped from 25 days all the way to 94 days. Basically, this means they are aggressively booking revenue way faster than they are actually collecting the cash.
And guess what? This exact same technique was used by the edtech giant Byju's. Notice the chronological events detailed right here. Byju's booked multi-year courses on day one instead of properly spreading them out over time. And it produced the exact same warning signs we just saw with ClearView. Massive revenue growth on paper, while actual cash collection fell far behind. This super aggressive revenue recognition eventually led to severe auditor disputes and, well, their spectacular downfall.
On the ViewPoint, let's move right along to Technique 2, depreciation magic.
Think about buying a laptop that you plan to use for 4 years. If you suddenly decide to spread that cost over 10 years instead, your annual expense drops dramatically, and boom, your profit artificially rises. Look at how ClearView used this magic, which, by the way, is governed by Ind IS 16 and Schedule 2 disclosure requirements. By extending their server infrastructure life from 4 years to 10 years, their annual depreciation expense fell from rupees 494 lakhs down to just rupees 198 lakhs. That instantly created an artificial annual profit boost of rupees 296 lakhs. It's the exact same business, the exact same servers, just a completely different accounting estimate.
Now, over 5 years, this simple trick creates a massive cumulative profit inflation of rupees 1,480 lakhs. And here's the crazy part. This is completely legal if it's disclosed. Jet Airways once used a very similar depreciation change to boost their profits by rupees 920 crores in a single year. You absolutely have to actively read the notes to accounts to catch this trick, or you'll miss it entirely.
On the ViewPoint, we look at Technique 3, related party transactions. Imagine a family business. Let's say a brother sells goods to his sister's retail store at triple the normal price, just to make his side look super profitable. But as a family unit, they haven't actually made a single extra dime. This happens in the corporate world under Ind IS 24. Insiders essentially trade with themselves to artificially shift profits around. Look at ClearView's related party disclosures. They sold a software license to their own subsidiary for rupees 380 lakhs, when the actual market rate is only rupees 80 lakhs. So revenue was magically inflated by rupees 300 lakhs. They also purchased cloud infrastructure from a promoter entity for rupees 285 lakhs, when the market rate was just rupees 150 lakhs. They are literally extracting wealth straight out of the listed company.
Naturally, this creates a massive red flag gap.
ClearView reported a standalone profit of rupees 1,689 lakhs. But when you look at the consolidated profit, which cancels out all these internal family trades, the real profit is only rupees 285 lakhs. That is a staggering gap of rupees 1,404 lakhs.
It's worth noting that this type of related party manipulation was at the very heart of the IL&FS crisis. They used a wildly complex web of 347 subsidiaries to shift money around and hide a staggering rupees 91,000 crores of debt across the group. The takeaway: if you don't carefully check related party transactions, you are basically flying blind as an investor.
On the ViewPoint, let's do a cash flow reality check.
As we've just seen with all these techniques, accounting profit is highly flexible. But cash flow? That's your ultimate lie detector. It is incredibly hard to manipulate actual cash sitting in the bank. A company can report literally any profit number it wants on paper, but it cannot report cash it does not actually have. Let's contrast our two companies. Even with honest accounting, ClearView shows a profit of rupees 850 lakhs. Yet, their cash flow from operations is a negative rupees 250 lakhs. This means they have a severely negative cash conversion ratio. Now compare that with Freshmart Retail from our previous explainer, which converts its profits into cash at a very healthy 115%.
On the ViewPoint, we want to give you practical tools, so let's look at our warning signs checklist.
You can use these actionable questions straight out of the Startup Governance Playbook during your own stock analysis. Let's go through the 6 red flags together. First, is revenue growing much faster than cash flow? Always check the cash flow statement for this. Second, is days sales outstanding increasing year on year? You'll want to check trade receivables on the balance sheet. Third, has the company extended the useful life of its assets? Find this in the Significant Accounting Policies note. Fourth, is the standalone profit drastically higher than the consolidated profit? Compare both P&L statements side by side. Fifth, are there large transactions with promoter entities? Check the Related Party Disclosures note. And finally, sixth, is the cash conversion ratio consistently below 60%? Just divide operating cash flow by net profit to find out.
Remember, these are absolutely not just theoretical techniques. Look once again at the actual governance failures at Byju's, the lack of transparency, the delayed financial reporting, the auditor resignation. The exact same warnings we identified for ClearView were totally visible in Byju's financials well before the real-world catastrophe hit. The red flags are always there, if you just know how to read the data.
You now know 3 techniques. ClearView Technologies, a company just like thousands listed on Indian stock exchanges, used all 3. The numbers were there, the warnings were visible, you now know exactly where to look. Before you go, drop one comment below. Which of these 3 surprised you most? I read every single comment on the ViewPoint. And please, subscribe to the ViewPoint right now. New honest analysis every week. This is the ViewPoint. See you next week.